Hey everyone, welcome back to our simple explanation of the S&P 500. In part 1, we covered the basics. Now let's get into the nitty-gritty of how it all works and why it matters so much to investors like you and me. So, how is this magical number, the S&P 500 index value, actually calculated? It's not just a simple average of the stock prices of all 500 companies. That would be too easy, right? Instead, it uses a method called market capitalization weighting. Sounds complicated, but the idea is simple. A company's market cap is its total value, calculated by multiplying its stock price by the number of outstanding shares. Think of it like this. Bigger, more valuable companies have a bigger impact on the index's movement. So, a company like Apple or Microsoft, with a huge market cap, will move the needle a lot more than a smaller company in the index. If Apple's stock goes up by 1%, it has a much larger effect on the S&P 500's overall value than if a smaller company's stock goes up by the same 1%. This method ensures the index truly reflects the overall health and trends of the largest players in the U.S. stock market. So why do investors care so much about the S&P 500? Well, for starters, it's a fantastic benchmark. If you're investing in U.S. stocks, you can compare your portfolio's performance against the S&P 500. Did you beat the market? Did you lag behind? The index gives you a clear yardstick to measure your success. Many professional fund managers are judged by whether they can consistently outperform the S&P 500. Spoiler alert, it's harder than it sounds. Another huge reason is the rise of index funds and ETFs, which are exchange-traded funds. These are investment products designed to mimic the performance of the S&P 500. So, instead of picking and choosing individual stocks, you can buy a single share of an S&P 500 index fund or ETF. This instantly gives you a small piece of all 500 companies. It's a super simple, low-cost way to diversify your investments across the broad U.S. market. For many people, this is the cornerstone of their long-term investment strategy. It's diversification made easy. So what does the S&P 500 actually tell us? When you see on the news that the S&P 500 is up, it generally means that, on average, the largest public companies in the U.S. are doing well. Their stock values are increasing. This is often seen as a sign of a healthy, growing economy. It suggests that businesses are profitable, investor confidence is high, and the economic outlook is positive. People might feel more confident about spending money, and companies might be more willing to hire and expand. On the flip side, if the S&P 500 is down, it can signal economic trouble ahead. It might indicate that corporate profits are shrinking, investors are getting nervous, and a recession could be on the horizon. It's essentially a real-time report card on the health of corporate America and, by extension, the broader U.S. economy. While it's not a perfect crystal ball, no single indicator is. It's one of the most closely watched and respected barometers of market sentiment and economic health that we have. All right, let's do a quick summary of everything we've talked about. The S&P 500 is calculated using market cap weighting, meaning larger companies have a bigger influence on its value. Investors care about it because it's a key benchmark for performance and because it allows for easy, diversified investing through index funds and ETFs. Finally, the movement of the S&P 500 gives us valuable insights into the health of the stock market and the overall U.S. economy. A rising index often signals economic strength, while a falling one can be a warning sign. And there you have it. The S&P 500 explained. It's not some mysterious code. It's a powerful tool that helps us understand the market and make smarter investment decisions. Hopefully, you now feel much more confident when you hear about it in the news. Thanks so much for watching. If you found this helpful, please give this video a thumbs up and don't forget to subscribe for more simple explanations of complex financial topics.